Good evening, all, and welcome to this presentation on whether mergers and acquisition lead to increased shareholder wealth in Malaysia. Mergers and acquisition activities are a popular strategic tool for companies looking to expand operations, diversify risk, or strengthen market dominance. However, the outcome can vary significantly, particularly in developing economies like Malaysia, where political, structural, and regulatory factors play a major role. This session we will explore both the theoretical and empirical aspect of mergers and acquisition, discuss the main arguments for and against this effectiveness in increasing shareholder value, and highlight key data and trends within the Malaysia market. We'll also analyze a case study, CIMB acquisition of Southern Bank, to better understand the real-world implication. By end of this presentation, you should have a well-rounded perspective on how mergers and acquisition function in Malaysia and whether they deliver the promised benefit to shareholder. We'll move on to the next slide. Introduction it is. Mergers and acquisition are essential corporate strategies designed to achieve rapid business growth, diversify revenue stream, and also secure a competitive edge. These transactions often result in significant shift in company structure, operational system, and financial standing. While theory suggests that mergers and acquisition improve shareholder wealth through enhanced efficiency, broader market access, and cost saving, the practical reality is more complex, particularly in Malaysia. The Malaysian business landscape presents unique challenges, including political involvement, state-linked enterprise, and evolving regulatory framework. This presentation will analyze whether mergers and acquisition in Malaysia deliver on their promise to shareholder. The discussion combines financial performance data, market reaction, and corporate governance factor to provide a holistic view. To support this analysis, a real-world case studies involving CIMB and Southern Bank will be presented, offering insights into how theoretical benefit translate into actual outcome within Malaysia's unique environment. In understanding the shareholder wealth in mergers and acquisition, it's very important to determine whether mergers and acquisition enhance the shareholders' wealth. We need to understand how the wealth is being measured. Common indicators include stock price movement, dividend growth, and overall return on investment. A sharp increase in a company's share price after a mergers and acquisition announcement is typically viewed as a positive market response, indicating investors' confidence in the deal's potential. Additionally, financial performance metrics like economic value added, return of equity, and earnings per share are used to assess operational and profitability improvements post-merger. However, in Malaysia, shareholder wealth outcomes are often influenced by corporate structures, particularly the prevalence of government-linked companies, GLC, and family-owned enterprise. These firms are subject to different expectation, governance model, and a strategic objective, making it harder to assess shareholder outcome using Western metrics alone. Therefore, a nuanced approach is required when evaluating mergers and acquisitions success in this content. Moving on, Malaysia has experienced several waves of mergers and acquisition activity, particularly during the financial deregulation of the 1990s and restructuring that followed the Asian financial crisis. These events catalyzed consolidation in strategic industries such as oil and gas, banking, telecommunication, and plantation. Many of these deals were driven by government initiatives involving GLCs, particularly in the banking sector, where mergers were encouraged to build national champions. In more recent years, Malaysian firms like Sime Darby have pursued cross-border acquisition to and expand diversify and expand their global footprint. Conversely, foreign investors have targeted Malaysian firms, especially in infrastructure and real estate sector. These evolving trends highlight Malaysia's dual role as both an acquirer and a target in the international mergers and acquisition space. However, local regulatory framework, political sensitivities, and economic condition heavily influence how these transactions are structured and received by the market. In this next slide, we'll be explaining on why mergers and acquisition can increase shareholder wealth. Technically, mergers and acquisition can be powerful tool for boosting shareholder wealth when executed strategically. One of the main drivers of value is realization of synergy, both cost saving and revenue enhancing. By integrating operations, companies can reduce redundancy and improve efficiency. And another advantage is improved market position, in which allowing the merged entity to capture a large market share and strengthen the pricing power and negotiate better supplier terms. Mergers and acquisition also facilitate risk diversification. Firms can mitigate sector-specific or geographic risk by expanding into new areas. Additionally, larger post-merger firms often enjoy better credit ratings, broader investor access, and richer talent pool all of which supports long-term innovation and growth. As in Malaysia, these benefits have been observed in sectors like banking and telecommunication, where successful mergers have advantages depends heavily on strategic fit, integration planning, and execution excellence. And in this slide, we will be explaining on it's a argument on why mergers and acquisition may not always benefit shareholder. Despite their potential, many mergers and acquisitions fail to deliver shareholder value, and Malaysia is no exception. A common issue is overvaluation. Acquiring companies often pay premiums that aren't justified by long-term gains, especially when driven by political motives or executive ambition. This has been observed in some Malaysian deals, such as Sime Darby's costly foreign acquisition. Another major hurdle is post-merger integration. Combining different corporate cultures, system, and leadership styles can create friction, especially in Malaysia's diverse multicultural business environment. This regulatory and political risk also complicate the transaction, as mergers and acquisition often face delays or opposition due to policy changes or public scrutiny, especially when involving GLC. Lastly, while mergers and acquisition announcements may excite investors and trigger shorter term share price increases, the long-term return may fall short if synergies are not realized or if financial burdens increase. Without disciplined strategy and integration, mergers and acquisition can end up reducing, not increasing shareholders' wealth. In this slide, we'll be explaining on the empirical data from Malaysia. Empirical studies on mergers and acquisition outcome in Malaysia have produced mixed findings. Research by Limac and Co. in 2007, for instance, confirmed a global trend. Target company shareholders generally benefit more than acquirers. This is this is largely due to the premiums paid by buyers, which can strain future profitabilities. In Malaysia, the problem is further complicated by the presence of GLCs, where acquisition may be politically or socially motivated instead of aiming for shareholder return, such deals may pursue national objectives like increasing the Bumiputra equity or job creation. These alternatives motive can dilute the focus on maximizing the returns. And additionally, market responses were based on the transparency and strategic clarity of the deal. Investors are cautioned when they perceive weak alignment or overpayment. The key takeaway from Malaysian data is that mergers and acquisition success is highly situational. Outcomes are influenced as much by governance and execution as by financial strategy. Moving on, we'll be explaining on the CIMB and Southern Bank 2006 case study. So as for this case study, in 2006, acquisition of Southern Bank Berhad by CIMB offers valuable insight into the realities of mergers and acquisition in Malaysia. CIMB, a government-linked bank through Khazanah Nasional, sought to acquire Southern Bank Berhad, a successful mid-sized private bank. The deal faced public scrutiny and internal resistance. Southern Bank Berhad CEO opposed the takeover, claiming the undervaluation and lack of strategic rationale. Analysts criticized the small premium offered to shareholders and questioned the long-term benefit. Although Southern Bank Berhad's share price briefly rose after the announcement, the integration process proved complex and costly for CIB. While the merger ultimately positioned CIB as a leading Southeast Asia bank, shareholders' return in the year in the years that followed did not dramatically outpace the competitors. This case shows that even well-intentioned and executed mergers and acquisition can struggle to generate clear financial gain for shareholders. A strategic alignment deal, transparency and integration planning are crucial for success in similar future deals. Moving to the next slide, where we'll have a critical reflection. Theoretical models suggest that mergers and acquisitions should increase shareholder wealth through synergies, market expansion, and improve capital efficiency. However, the Malaysian business environment adds several complicating factors. The country's relatively small and less liquid capital market, combined with significant government involvement in strategic sectors, affects deal dynamics. Additionally, many Malaysian firms are family-owned, and corporate governance practices are not always aligned with global standards. These contextual issues limit the applicability of global best practices. Furthermore, soft factors like cultural compatibility, leadership quality, and employee integration often play a bigger role in determining mergers and acquisition success than hard financial metrics alone. Deals may look promising on papers but fail in execution. Therefore, mergers and acquisition outcome in Malaysia can't be judged solely on size or ambition. They must be evaluated through a more holistic lens that consider governance, strategy, human capital, and country's unique political economy. To conclude, mergers and acquisition in Malaysia offer both opportunities and risk. While they can boost shareholder value through operational synergies and strategic expansion, success is far from guaranteed. Empirical evidence show that shareholders of the target firms often fare better than those of acquiring companies. Many deals flatter due to overvaluation, poor integration, or misalignment with long-term strategy. Political and regulatory consideration also play a larger role in Malaysia than in more liberalized economies. The CIMB and Southern Bank Berhad case reflects these mixed results. Success in creating a larger entity did not necessarily translate to superior shareholder return. Ultimately, mergers and acquisition value creation in Malaysia depends on clear strategy, transparent execution, strong governance, and context-sensitive integration. Investors, analysts, and policymakers should assess each mergers and acquisition case individually rather than assuming that consolidation inherently leads to better financial outcome. Critical thinking and due diligence are essential when evaluating the true impact of mergers and acquisition on shareholder wealth. Thank you.